So today, to the uninformed, the topics I'm going to cover today might seem unrelated, but I've had it on good authority that you're a very informed group. So I'm sure you'll get where the three relatively unrelated points all come together towards the end. We're going to cover really back to the basics of behavioral finance. It's not a session on behavioral finance today. I'm going to focus on what I think is the main element of behavioral finance. We'll talk about that. Then we'll talk about the Australian experience. I'll lead that into the concept of goals-based advice. Okay. And then we'll tie it all together and where to from here. Okay. Everyone happy with that? Good. Let's go. If you're not, bad luck. That's what you're going to get. So let's start with behavioral finance. Hands up if you've heard of Adam Smith before. Everyone's heard of Adam Smith, right? Wealth of Nations, in the 1700s, wrote the book, which really was the precursor to the concept of economics. Okay. Now, Adam Smith wrote two books. He wrote The Wealth of Nations, which talked about the invisible hand and how society works. But 17 years earlier, he wrote the book called The Moral Sentiments, which to me was the real origin of behavioral finance. He linked the idea of morality to financial decision-making and economic decision-making. Okay. Then we kind of forgot about it for a long time. And probably in the early 1900s, we moved down this traditional or neoclassical economic approach, which is kind of typified by this concept that Richard Thaler called Homo economicus, so the economic man or the rational man model, which is that we are all victims of wanting to maximize our utility. Okay, every decision we make is rationally based on wanting to maximize our utility, right? So that makes sense to everyone? So I want to get the best outcome for everything. Now, that held for a long time, okay? Held for a long time until two Israeli psychologists sat down in their mess hall in Tel Aviv University and were reading some economics books and started reading about this rational man. And as psychologists, they went, what? Rational man? There is no such person as rational man. No one's rational. We exist as psychologists. Those psychologists were Daniel Kahneman and Amos Tversky. And they started investigating. This is because basically Tel Aviv University, the economics department and the psychology department shared a building. And they started to look at, well, hang on a minute, if the whole basis of traditional economics is rational man, and there is no such person, doesn't that compromise everything around traditional economics? And really at that point, the more contemporary view of behavioral finance was formed. Okay. Now they became quite famous. Well, don't read these. This is just 30 of the common behavioral biases. Okay. Now I'll put this on just to show that it's exploded into a whole nother field. Okay. A whole nother field of psychologists wanting to make a name for themselves by identifying mismatches of rationality. Okay. So all these biases have been identified typically by psychologically based studies that have looked for mathematically where people make irrational decisions. Okay. So the classic example is the kind of coin toss. If I'm tossing a coin and I get 10 heads in a row, who would think if you had to bet 10 heads in a row, who would bet that the next turn would be a head? Who would bet it would be a tail? So hands up, come on. Most would say more likely to be a tail, right? Because of 12 in a row. And the behavioral scientists would say, aha, gotcha, aha, that's a bias because obviously it's exactly the same probability, okay? The fact that we make a decision is often deemed as being evidence why there's behavioral biases, okay? Now, I started my journey around behavioral finance around about 12 years ago. I read Tversky's book. Anyone read Tversky's book, Thinking Fast and Slow? Yep. Anyone read the whole book? Because most people read the first bit, yeah. But if you read the whole book, it's pretty cool. It's pretty interesting. And I was totally engrossed in the idea of behavioral finance. Then I started a doctorate focusing on investment decision-making and financial decision-making. And through that process, I became a little bit more skeptical about some of the elements of behavioral finance. So we tend to take these as all a given, right? And we look at our clients and go, oh, hang on, yep, that's a paradox of choice bias you're showing. Gotcha. Now that, then oh, hang on a minute. This sunk cost fallacy is why I don't want to sell this investment. I understand that. Okay. And that's true. But all of these biases have been proved by identifying mathematically that people made the wrong decision. Okay. Now, we all know, because we deal with clients every day, clients are financially illiterate, right? That's why they use us as financial advisors, is because they don't understand things. We understand things because we're better trained. We've spent more time doing it. We've had more time to think about it. We are also as subject to these biases as our clients. So just knowing about them doesn't stop us being biased, okay? Always remember that. It doesn't stop us being biased. We still have the same biases. So Tversky talked about in his book, this is topical at the moment, I shouldn't probably go in this path, I'm not using this for any other purpose, but in the Israeli army, he was employed to try and identify the best quality captains. So of all the recruits came through, him and a group of psychologists, you study them, you know what's going on, look for their biases and see which ones are going to make the best captains. And he said we got it wrong almost every time, okay? But we kept doing it. We had a methodology we were applying and we kept doing it, okay? Because, well, probably we were right, okay? So the bias occurs irrelevant all the way through. But Tversky and Kahneman were famous for introducing the concept of prospect theory. Who's heard of prospect theory before? Yep. If you have, hands up so I can see. So a few, but not everyone. Prospect theory was what won Kahneman the Nobel Prize. Tversky would have won it, except you've got to be alive to win the prize, and Tversky unfortunately died the year before it was won, so it was only Kahneman. So he gets the whole $1 million. So, but prospect theory was the great evidence of that neoclassical economics is wrong. Okay, because what it found was people despair of losses much more than they enjoy gains. Right? Practically, what does that mean? It means that if I lost $10, would feel the same, but the opposite of winning $20. Right? To get that same emotional opposite, but the same emotion, I'd have to win twice as much as I lost. Does that make sense to everyone? So you would think rationally, $10 is $10, right? If I lose $10, I win $10, it should give me exactly the same emotion. But it doesn't. Losing the $10 gives me a lot more emotion than winning $10. And introduce the concept of loss aversion, which I'm sure we've all experienced amongst our clients. Okay? The concept of loss aversion. Loss aversion is really, really important. And this little graph just talks about the gains, they level out. So winning $100, winning $1,000, winning $10,000, it doesn't change much. Losing $100, losing $200, losing $500 hurts a lot more. So there's an imbalance between gains and losses, and it leads to this concept of loss aversion. Now, we know about that, but part of what they also found was that when people are facing certain losses, they become risk seekers. Okay? And that's what I want to talk about for a couple of minutes. So it's really important, I think, we get on this. So prospect theory, yep, we know they feel more than lose, that's fine, and leads to loss aversion. But this idea that those facing almost certain losses become risk-seeking, and those feeling almost certain losses become risk-seeking, okay? So let's talk about that for a minute, because risk-seeking means I don't mean to, but I'm much more willing to take on risks to try and get things back on track, all right? So it's not just actually losses, I think it's facing and feeling losses as well, right? So who faces and feels losses? Well, I think young non-homeowners, Australian property market's the same as the Irish property market, is stupidly expensive, and young people have trouble getting into the housing market, yeah? So young non-homeowners who think they can't get ahead, they want to take risk-seeking behaviour. They want to put their savings for the deposit into high-growth equity funds, all right? So there's a huge timing mismatch between what they want to do. So they want to take risk to try and get the money because they think they should have a house. I think those over 50s with large debts who have found themselves with large debts and not paid it off, how do I get rid of the debt before I retire? So I'm feeling a loss. I haven't lost anything. There's no actual loss here, but I'm going to feel it. I'm going to feel like I'm going to face this loss. I think approaching retirement with not enough saved. There's a big mismatch between, and we all experience this, where people have a lifestyle that they spend a lot of money on and realise at the last minute, hang on, my lifestyle's going to be awfully different in retirement. I call this retirement cliff. So people keep living up to the level of expenditure up to the date of retirement, and the day of retirement, their income drops and goes like this, okay? They fall off the retirement cliff. Now, practically, what do we do for that? Well, we identify the retirement cliff as early as possible perhaps up to 10 years before retirement, and I start taking money off the table. So every year we increase a contribution to a savings vehicle. In Australia, that would be superannuation. So we increase. So I'll give them less and less disposable income. So I try and flatten that curve out so the loss is low, because they've got more at retirement than they would have had if they just kept spending up their level. But we see people who don't get advice, who don't think about that, they just keep spending. Every time you get a pay rise, you notice the pay rise for how many pay periods? 1. Right? You get a pay rise and you notice the pay increase for 1 pay period. And then we instantly adapt to the higher level of income we're earning, and our expenses go up. Okay, very rare for people to say, great, I'm going to save that extra money. That's up to people like us to say, you need to save that extra bit of money, because there's a huge mismatch between your level of expenditure today and what your level of expenditure will be in 6 or 8 or 10 years' time. And that's where financial modelling comes in, because we can work out what that's going to be. So I think that's the big issue. I think people with friends who seem to be able to afford everything. Now, we don't know whether these people are taking on massive debt. We don't know whether they fit in the other categories. But you've got people who seem to be travelling overseas every year, who buy new cars every year, upgrade their house every couple of years. It's kind of like the keeping up with the Joneses thing. If I'm not, why aren't I? What am I doing wrong? We never ask, what are they doing wrong? But what am I doing wrong? Problem gamblers, okay? So sports betting. I haven't watched much television since I've been here, but in Australia, almost every ad break has an online betting ad. And certainly the majority of ads are all sporting events. It's become totally normalised. Sports betting amongst the younger generation, probably the sub 40-year-olds. I'm old, but it's the sub 40-year-olds. It's become normalised. It's become a form of investment like cryptocurrency, okay, which is a form of speculation. It's not investing. So that's what they think. And I think, when the market falls, okay, people are facing almost, that's in their portfolio value drop, okay? And they're more likely to take on risky behaviour. Now, that risky behaviour is not about taking on more investment risk. They might be cashing in their investment, right? That might be the risky behaviour. I'll cash in my investment, okay? But they want to take on this risky behaviour. So I think it's important that we understand the role of prospect theory in this, and we look for it. We're not just looking at investment losses, but we're looking at other things as well, okay? So how does it manifest itself? Well, we see FOMO. That term's familiar for you guys? Yeah, FOMO, fear of missing out. So house prices. Now, in Australia, again, I'll talk about Australia, but the majority of houses are sold by auction in Australia, okay? About 75% of houses are sold by auction. Now, auction's terrible, unless you're selling. Because what happens at an auction is that there's hands go up, okay? So I want to pay $1 million for the house. I think it's worth I pay $1 million, $1 million. And someone says, $1.5 million. Oh, I really want the house, $1.10 million. So do they, $1.20 million. And so the $1 million house sells for $1.2 million or $1.3 million. And that sets a new price for everyone else's expectations. Okay, everyone else's expectations. My thesis was on people's understanding of property price growth, how it works. Now, what I found, aside from the real findings, people know exactly what their house is worth. So here, same. If you ask a person in Australia what their house is worth, they'll tell you to within $1,000, right? And you're talking about a house worth $1.5 million. Oh, it's worth $1.57 million. How the hell do you know what that price is? Oh, well, it always goes like this. The house across the road sold for $1.5 million, and mine's a better house than that. I've never had a person yet who said, mine's not quite as good as that house. It's either bigger block of land, better renovation, but it's always a bit better. And that's the base of how they work it. So these expectations get created. Now, I don't believe you can price a property accurately within at least a few percent, but there's not, if I think it's worth, if I'm a seller, I think it's worth $1 million, someone offers me $998,000, oh no, pass the property in. I won't sell it. I'll wait till they offer me exactly what I want. What do I want? What I want is what I think it's worth, okay? So for young people, that's what's driving up house prices, but you can see how I keep going to auction, I keep missing out. I need more all the time, okay? Crypto investors. Now in Australia, it's illegal for registered financial advisors to give advice on crypto. Thank goodness, okay? Thank goodness. Can you guys advise on crypto? No, good. Don't push for it, because how the hell can you make a recommendation on crypto? What's the basis of evaluation for a cryptocurrency? Okay, it's what Keynes would say. Maynard Keynes would say is the greater fool theory. okay, or a beauty pageant. There is no way of valuing the asset. Bitcoin, how can Bitcoin be worth 100,000 US dollars? How? Okay. It's not. It's only worth $100,000 because someone is silly enough to pay $100,000 for it. And it's perfectly fine to buy it for $100,000 as long as someone's silly enough to pay $101,000 for it. Right? So it's just a giant Ponzi scheme. But as long as people are happy to pay a high price, it's fine. So it's a real challenge with crypto. Reddit investors. Anyone seen the movie Dumb Money? No? Worth a watch. Worth a watch. There was during the GFC, during the global recession, post-global recession, there was one little guy in a basement in America who ran a podcast. And the podcast was around what's my stock tip, okay? And his stock tip was a company called GameStop. Now, GameStop is still around. It was about to go bankrupt. GameStop sold hard copy video games. It was like a store like Blockbuster Video. And you go and buy video games from the store. Now, everyone buys them online now. All the stuff, you don't buy a video game anymore, right? So it's going broke. So all of the, hedge funds in America were shorting the stock, right? Massively shorting it. And then this one guy who had this following said, I think that's what you should be buying. And there was a massive groundswell of people who started buying the stock. And it went up like 1,000%. Right? Incredibly. And these people who are watching this podcast made millions. And the hedge funds who geared into shorting lost billions of dollars. Okay? And that was a great win for the guy, right? That was what it was all about. But the fact is, all these people, when you look at them, because I was looking at it from a different lens, it talks about all the people who were buying. These were people with nothing. Okay? These were people who had nothing, who thought this is my last chance. And this is putting all their money on this little tiny stock that had been plummeting for a long period of time. To me, that's a classic example of risk-seeking behavior when you're facing almost certain losses. Taking on debt to fund lifestyle, buy a franchise to make my own boss. Okay, big mistake in Australia. And then I'll back everything on the last in the racetrack. The classic kind of example is I've had a bad day at the races, and so therefore I'll bet big on the last because I'll get all my money back. Right, so it's classic risk-seeking behavior. Okay, so how does this relate to portfolio recommendations? Is number one, we have to understand what it's all about. Okay, understand that this feeling is unavoidable. So clients are going to feel loss aversion. So how do we deal with it? We have some answers. We're prepared. One of the great roles of financial advisors and financial planners is to be sense makers. We have to be able to explain to clients and make sense of things going on in the world. We have to be able to explain what's happening with Trump. Okay, good. Now, doesn't matter what you say, as long as what you say makes sense, because certainly what he says doesn't make sense. All right, so I need to do it. Can I exploit the opportunity? I was talking to a guy once who said, all my clients are in 100% international equities. That's the portfolio because that'll give them the best long-term return. Right now, probably it'll give them the best long-term return, right? 100% equity, that's what they're in. Except when the market falls 20%, what happens? They fall 20%, sometimes more. And what do they think? Loss aversion. What am I going to do? You made a mistake. You shouldn't have put me into that 100% equity portfolio because I've lost 20%. And they say things like, if this happens again for the next 5 years, I'll have no money. Experienced that before? 20% 1 year. If I lose it next year, another 20, another 20. In 4 years, I'll have no money left. What are you doing? Okay. So can I exploit the opportunity? Well, yeah. Don't have 100% in equities. I've got two simple options. I can have a passive diversification approach, which helps to minimize it, or I can have an active diversification approach. Certainly in our practice, we would always have cash or very considered fixed interest up our sleeve. So a high growth portfolio for us would be 80-20, not 100. Why? If the market falls 20%, I go, aha, opportunity. I can put that 20% of holding off into the market now. Okay? Put it into the market now. Aren't I wonderful? Because when it goes back up, you're going to have more than 100%. Because that 20% is going to grow as well as the 80% going to recover. So I can exploit the opportunity if I wanted to. Okay? It's, anyway, important to do. Front foot communication. During the financial crisis, I wrote a bulletin to our clients every week, every single week, okay, on the front foot. Here's what's happening. Here's what we're dealing about it. Here's what we think. Don't panic. And I made it as funny as I possibly could, okay? So I put little jokes and little images and cartoons into the communication, and that became what clients focused on. Every week they look forward to the jokes, right? They were getting a communication from me to help them make sense of things, but their mind was taken off what's happening beyond my control into something I can control, how I'm feeling about myself. You know, Paul's okay, he's under control. Look, he's even making jokes about this. Every week for 2 years, I wrote 200 words every single week and added whatever jokes I could find into it. And that became a thing. So what's my value add? That's the other thing. How am I adding value? And part of this is around what's my portfolio construction. And are my clients conditioned? I'm incredibly aware of loss aversion, and we talk about it at the very first appointment with clients. Okay, at the very first appointment with clients, we talk about it. So I understand most clients are loss averse. Loss averse means you'd rather not lose money than make as much as you possibly could, right? That's what it kind of means, right? So we build our portfolios on that basis, where we focus on risk first, return second. Okay, risk first, and that could be as simple as a diversified portfolio, right? That's all I'm saying. We focus on risk first and return second, because clients, they can't hear that word. They can't hear the word. Okay. So when you use the word, it just doesn't come out. They don't hear it. They hear return very clearly. Okay, but they can't hear the word because they just doesn't fit. All they want to know is what's the return, right? So it's important that you are on the front foot around that, because it's really, really important to do that. Okay, on the Australian experience. Now, a few little things about this. I know you guys have been struggling with the idea of auto enrolment for a long time. We started compulsory superannuation in 1992. Now, let's be kind of clear about where this came from. This was a tool to help control inflation in Australia. Okay, don't think it was some big, Paul Keating gets held up. Great, did a great job. We had inflation at double digits all through the 80s, like most places did. And his job was trying to get inflation down. He created a recession, but he knew that wages growth was fueling inflation. So what's he do? Okay, says to the employers, don't give your staff pay rise next year, start putting 3% into superannuation, because it's not inflationary. They can't touch it till they retire. They get a pay rise on paper, but it goes straight into something they can't touch till they retire. So 2 birds, 1 stone. Okay. Now, it's not 3% anymore. It was 3, it's now 12%. It's been progressively increasing, and it aims to go to 15 perhaps in the next few years. So it's 15% of every person's wage goes into a superannuation fund. And it's grown the fund to now the 3rd largest pool of money in the world. It's now $4 trillion. Okay? $4 trillion. Now, what's so good about it, Ireland has an EET system. If you're familiar with those terms, E and T. So E is how something described academically. Exempt on the way in, exempt earnings when it's in there, taxable when it comes out. Yep, typically that's how it works. So EET system. Australia's a bit different. We have a E in brackets. I have a choice of putting money in to super on a tax-free basis, or I can take it from my salary, which I know you guys can't. If it comes from my salary, it's taxed at a flat 15%. So instead of my marginal tax rate, which could be in Australia 47%, the money that I put into super is only taxed at 15. So it's a small t, not a big T. Okay, concessionally taxed. When it's in the fund, it's also concessionally taxed. So the earnings are taxed at 15%. Okay, so not marginal rate, but 15% tax. But the big kicker is the E at the end. You know what that means, right? So all payments made from a super fund, whether it's lump sums or pensions, after age 60 is exempt for life. Okay? Consequently, can you kind of see why people want to put as much money as possible into superannuation? From a retirement planning point of view, there is nothing, I don't think there's anything in the world as efficient as this. If I win $1 million, I can't put $1 million in now, I'm capped on liquidity, but I put $330,000 in a single year, exempt. Or I can put up to $30,000 every year on a concessionally taxed basis. The fund can grow to whatever. It only starts to be taxed once I get to 1.9 million, okay? And then it's taxed at 15%. But up to 1.9 million, it's tax-free. And any lump sums I withdraw, no matter what the balance is, are tax-free, okay? So it's a pretty efficient system, and hence it's grown. Now, this big system up here, the big amount of money, is why one of the reasons financial advice has become so heavily regulated in Australia, okay? Incredibly regulated. And because regulators think, hang on, giant pool of money, what are you guys doing with it? So regulated, okay? But we also have a means tested state pension, age pension. You guys have a non-means tested age pension, right? So pretty much everyone gets an age pension if it's 60, 67, right? Same as a 67 age pension, but it's a means tested age pension. So in Australia, you get a full age pension, which for a couple in dollars, you can work at the calculation, is around about $45,000 for a couple, around about $30,000 for a single. It's not massively different to the Irish pension, about $45,000 for a couple. But I only get that pension if I have less than $400,000 of assets, excluding my house. And if I go over $400,000, it starts to shade down. The more I've got, the less I get. And if I have around $1 million in assets other than my house, the pension shades out. So it's a means-tested pension, which has added a complication for us. All right, so the Australian experience, just to go back a little bit more, is we had the global financial crisis 2007, 2009, and we all experienced that, didn't we? We all got the blame for it, didn't we? It was our fault that Standard & Poor's did what they did, and Goldman Sachs. So we took the blame. All the client losses were down to us. In 2013, 12 years ago, that led to a complete commission ban on all pension and investment products, right? No commissions. There's been no commissions in Australia on pension and investment products for 12 years. In 2013, they also mandated caps on life insurance policies. So that maximum commission you can earn on a life insurance policy is 60% up front and 20% trail. Okay? Now, we then had a Royal Commission a bit late. The Royal Commission, which is a big, huge inquisition. Yeah, you wouldn't have Royal Commissions here. Okay, I understand that. In Australia, we have Royal Commissions, which is a big inquisitive thing, huge. It was into misconduct in banking and finance. Again, who got the blame? Financial advisors for all the things that went wrong. Okay, and part of that was to introduce mandatory education standards. Now, you guys have a terrific education standard here. I just finished it. Just did the QFA course. It's Joanne's here. Wrong one, I know, but sorry, Joan. But you got a great system. 6 units, and you're a qualified financial advisor. Okay. In Australia, you used to have a diploma of financial planning, which was 8 units, pretty similar, affordable. You could do that at the start. Now, these new education rules say, sorry, minimum qualification, a 24-unit undergraduate degree. Now, a 24-unit undergraduate degree in Australia costs about $30,000. Okay, so do the degree, $30,000, and then I've got to do a professional year where I can't see clients, like an apprenticeship. I've got to spend a year doing it. So someone like me as a business owner has to employ someone on spec that they'll be good enough in a year's time to start earning some money. Pretty hard. Okay. In fact, I'll talk about me for a second, but the education requirements specify which course. I've been doing this for 30 years. I've got 2 master's degrees, a doctorate, a diploma, I'm a CFP. I would not qualify under the rules. Okay. So my qualifications wouldn't count because I didn't have the right degree. I've been teaching the right degree for 15 years, but I would have to go and do the degree, right? So after everyone went and did the degree or left, a number of advisors dropped from 28,000 to 16,000. There's 16,000 advisors in Australia. Just left, saying, I'm not going to meet that requirement, I'm going. Okay. After it's nearly 7 years of saying it's going to come in 2026, 2020, if not qualified 2026, you're out. Last year, they said, change my mind. If you've been doing it for 10 years, you're fine. So all these people had gone to the expense of doing the course. In the end, they said, don't do it. Sorry about that. So spend the 30 grand and the time to do it. So a real challenge. Okay. So what they wanted was more affordable advice, more accessible advice, and better quality advice. What they got, advisors' numbers dropped from 28,000 to 16,000. The compliance burden meant increased cost to use. There was a reduction in numbers of advisors, meant the cost went up because supply and demand. People could charge more because less people. And a really, really compromised life fixing industry. Okay, we've got a number of players have left the market. It's really, really hard to get life insurance in Australia. Okay, sounds ridiculous to say that, but when you take all the commissions away, the entire sales model and transactional models disappeared. Life companies aren't making any money. So it's a real challenge. That's what they got. But they've got better quality advice because people are more qualified. 40 hours minimum of compulsory CPD every year. 9 of those hours have to be ethics training every year. Okay, it's onerous. Okay, it's very lucrative in Australia, but geez, it's hard to become a financial advisor in Australia. Okay, so the ones that are left are making a lot of money. Okay, so advisors need to justify their fees. Okay, because no commissions. I've got to write to every client every year with the stated annual dollar-based fee I'm going to charge them in the next year, and they have to sign off on it. Right? So people often say to me, "Oh, hang on, trail commissions, annual fee, same thing." No, no, no. No. If you have to write to the client and ask them, would you like to pay for another year at $5,000 or $6,000 or $10,000? And you would say yes. Okay? Because the trail just keeps going. Right? So there's not an imperative to justify the value for the trail that you're getting. Right? Does that make sense? So I'm not having a crack. I'm just saying there's not an imperative because they just pay. Once they sign up, they just keep paying the trail until something changes. Okay? So it led to significantly improved professionalism because we had to justify what we were doing. That wasn't always welcome. A lot of people said, I don't want to be a profession. I'm happy with commission. So they put a bit of pushback. There's much, much more reduced access to advice. And advice saying, I'm not going to see, why would I bother seeing a low value client when there's almost unlimited people who happen to pay me, the average upfront cost for advice in Australia is between $4,000 and $6,000. Average ongoing advice fee in Australia would be between $4,000 and $6,000. So it limits the market down to, but the demand is way outstripping supply. Okay, way outstripping supply. So, but it has led to massively improved levels of trust. Advisors were way down the list of thoroughest trusted professionals. Now we're way at the top. We're very materially above politicians, okay, which is no great thing. Which kind of leads me on to goals-based advice, okay? Goals-based advice. Here's what I call the 6-step financial planning process. It's a little bit different. When I did the QFA course in Ireland, it's a little bit different. There's a little bit more product focus in the 6-step process. But here, this is how it works in Australia. We work this way. I've shortcut it with my fingers. Where is the client now? Which is the fact-finding tool. Okay, where is the client? Do I know enough about the client to add real value to this client? And the fact-finding process can add real value. Okay, so where's the client now? Where they want to be, the goal-setting process. Thinking over the horizon, what about all the goals we want to talk about? And not just asking them, do you have any goals? Because they look at you with that blank stare. Okay, no. Get rich, I don't know, whatever it happens to be. Next thing, what are they doing about it? What's the modeling show of the gaps? So you've told me where you are now, you told me what you're doing about it. Am I using whatever I'm using? Could be Voyant, could be whatever I'm using. I'm using that to say, okay, well, what's the gaps here? How are you not going to achieve the goals you've got? Once I know what they're not going to do, what they're not doing, I can tell them what I want them to do. That's my recommendations. And the recommendations, I give that with a statement of suitability. If they sign off on that, I start in the implementation workflow, implement the process. We go back, next step is review and monitor. Last step of every circle should be review and monitor, which is the review workflow. And then we go back in the review, where's the client now? What's changed? Has anything changed with your goals? Are we still on track? Do I need to change some of my recommendations? Let's change the recommendations. Let's review again. So it's like this loop that goes through. Now, clients really like this concept of a 6-step process. We all hear about it, but clients want to know, do you know what to do? And I'm getting about 2 minutes open. I'm going to digress for a second, but in a previous life, I was a paramedic. Go figure, okay? For about 10 years back in the 80s, a paramedic. Now, I worked in the city and country in Australia as a paramedic. After a few years doing it, I realised I kept hearing this word. No matter what situation I was going into, what horrible situation I was going into, I heard the same words every single time. And those words were, it's okay, the ambulance is here now. Right? No matter what I was going into. It's okay, the ambulance is here now. That's because I was wearing the uniform and their expectation was, this guy knows what to do. Right? And my job was to turn the chaos into calm. That was my job. Chaos into calm. Whether I saved a life or not, out of my control. Okay, out of my control. I did what I could, but out of my control. But my job was to know what to do. Sometimes that was calling the undertaker. Sometimes the family members. Sometimes the police. Sometimes splinting a broken leg. Okay, sometimes doing CPR. Whatever happened, I knew what to do. Now, that chaos to calm model, we've adopted in our practice for the last 20 years. I firmly believe when clients come and see us for the first time, they're in an emotional chaos. They're worried, they're going to be told, you've been doing it wrong all this time, you're an idiot, have you got not enough money, all this stuff goes on. They come in a very chaotic situation. And my job is to tell them, I know what to do, and this is how I do it. This is how we do it. Let's start by working out where you're at now. Let's go through and see how we want to get to in the future. What are you doing about it? I'll make some recommendations on that basis. We'll implement it, then we'll review. That's the loop we go through. I know what to do. And that turns that chaos into calm. That 6-step process, which we all talk about, just in lip service, is incredibly important, and we shouldn't just be paying lip service to it. So why do we do goals-based advice? Well, goals are forward-looking, okay? There's been a lot of academic evidence that says when products are, we look at product focus, it's past performance-based, right? I'm choosing this product because it's done this in the past. It's been the best performer for a period of time. Clients are prepared to pay a premium for forward-looking, all right? Clients will pay more if you promote forward-looking advice and not focusing. So can you kind of get that the idea of product focus is a bit backward-looking? You need a product. Here's the product. Why is it a good product? Because it's done well, right? Here's the past performance of that. But I'm focusing on goals. I'm talking about future, and clients are prepared to pay more. And regulators everywhere, including here, tend to look for justification of recommendations, right? That's what they're looking for. How can you justify the recommendation? Last year, which was great for our business, they said you're not capping enough fact finding. Okay, so that's what we want to do. And everyone has this concept of the best interest duty. This is overwhelming in Australia. The best interest is the recommendation in the best interest of the client. Now you guys have that with a statement of suitability. Best advice, right? Okay, whatever that means, because it's impossible to. There can be no such thing as best advice, right? It's a stupid thing. But the best advice and best interest duty is how it works for us. Okay. So, what are financial goals? What do they look like? Well, significant future expenses aren't part of regular expenses. That's what a goal consists of on the first pass. Things that require a financial amount, okay, that's outside of regular expenditure, that require a time frame. So dollar-based, time frame. So what's the goal? Buy a new car. When? 3 years' time. How much is it going to cost? 40,000. I've got a goal that's outside regular expenditure. That becomes a goal. I want to retire. When? I want to retire at 60. On how much? 80,000 euros a year. Right. That's a goal. Okay. So financial goals are time bound and dollar costed or euro costed. Okay. They should have a priority because people have a list of goals. I should be able to prioritize them to help me work out what my recommendations look like. And then ideally supported with what I say is a reason statement. And this is the difference between saying I've got a goal to travel. In 2 years, I want to travel overseas. It's going to cost me 25,000 euros. Okay, great. That's my goal. If I added in, where are you going? I'm going to Australia. I'm going to travel around Australia for a month. Okay, that's what the goal becomes. You want to travel around Australia for a month. It's going to cost you 25,000 euros and you're going to do it in 2 years' time. That little reason statement proves to the client I've listened to them. It proves I've really understood. What's retirement look like to you? What sort of car do you want to buy? What sort of university does your kid want to go to? Whatever those are. So they're the financial goals. There's other goals, which we've talked about. Neil was talking about estate planning goals. Okay? Estate planning is a big deal in Australia. It's simpler, much simpler, but it's a big deal. Okay? There is no inheritance tax in Australia. There is no capital access acquisition tax. There's no gifting tax in Australia. You can inherit from the parents at no capital gains tax, except if, and the principal residence is always exempt from capital gains tax. So if you inherit an investment property from a parent, you pay capital gains tax when you sell it, not when they die. So it's much simpler. So if you want to come to Australia, it's pretty easy. But that's what I'm talking about. So but estate planning still has the same issues because we have the same issues with blended families, right? And blended families is huge. When you asked about stepchildren, in Australia, a stepchild ceases to be a stepchild the moment the biological parent dies, right? Does that make sense? So I've got a stepchild. I'm the biological parent. My wife is a stepmother, and I die. Then there's no father. She can't be a stepmother anymore, right? Now that causes all sorts of issues with if there's multiple blended families, multiple children, who gets what? What if my wife remarries? She has other kids, and my kids miss out. All this sort of stuff happens. So we have a lot of work with estate planning lawyers, and I would say I spend a day a week with our estate planning lawyer with clients. I go in with them and I explain the situation. Look, any lawyers here in the room? Good. Lawyers aren't very good at being creative. They're very good at taking instructions, right? Give me the instructions. But they don't know what to ask. They don't know about the family arrangement. They don't know about the family. We do, because we talk to our clients about it. So the estate planning discussion is a pretty big deal. Okay, I better hurry because I'm running out of time. So personal insurances, work changes, family changes, these are other goals. Okay, but I've got to get clients thinking about these other goals. Then why don't we do financial goals? Well, clients don't understand them and they have trouble articulating their goals. Literally, if you said to a client, what goals have you got? How many of you will get a blank stare back? I don't know. They need to be prompted. Prompted. What happened to your kids if anything happened to you? Well, I don't know. Would you like to be looked after? Yeah, okay. Well, I've got an insurance goal. When you retire, what do you want to live on? I don't know. Well, here's what different amounts of money buys you in retirement. What sort of lifestyle do you want to have? Because we've got that costs. The lifestyle you want, you're talking about a 60 or 70,000 euro lifestyle. That's the goal. Okay. All those sort of things happen. So we can't just ask them what their goals are, because literally you get a blank stare. That's the area they skip. We have to prompt them, because we need to take a helicopter view versus what I call win-a-wimmy. Now, what does win-a-wimmy stand for? It stands for what is next is what is most important to the client. Okay? What is next is what is most important to the client. If they're going to buy a new car next year or have a European holiday next year, go to Spain for a month, that is a more important goal to them than retiring in 5 years' time. Okay? Because it's what's next. So what is next to a client is what is most important. And we're going to overcome that. We're going to give them a list of a whole bunch of goals. Typically in Australia, you have a list of maybe 5 to 7 goals to work on. Now, you might not achieve them all at the same time. Okay? You might not cover them all at the same time. It might be something you do over a period of time. You start with what are your priorities, but you know what the goals are. Okay? It's because clients hire us to assist them in reaching their desired goals. So how do we apply it? I'll go quick now. We break the actions down. We say, what is the goal? And on that goal basis, here is my recommendation. Okay, here's my recommendation. The recommendation needs to prove how I'm going to achieve the goal. It could be around, if it's a retirement goal, my recommendation could be around the timing of the goal. It could be around your income that you're going to have. It could be about contribution levels to pensions that you need to make. It could be about pension recommendations and why one is better than the other. And it could be about how you source your income, annuity versus PRSA, whatever it happens to be, okay? However you want to draw your income. But all of this is a recommendation, or a number of recommendations around a retirement goal, okay? So if it really comes down to why am I making this recommendation, and have I justified it? Okay, so how have I justified it? So does AI have a role in this? Okay, and who's really everyone hears AI, right, all the time. Everyone, yeah. Every time you turn something on, AI. AI is going to take our jobs. AI can do everything. AI can't do everything. Okay, it's limited. The case for it is I can technically get real-time risk monitoring. Not for us. Maybe big institutions can, but we can't get real-time risk monitoring for clients at this point. However, on-demand learning and research, terrific. What are the rules around, the CGT? If I frame the question right, something like ChatGPT, I get the right answer. I might want to check it, but it's usually pretty good, as long as I frame the question the right way. On the basis of Irish tax law, what is the answer to this question? Okay, look in the right spots. Natural language process like that. So in our software, we have AI called Simon Says, which means I can write a couple of points down, push the button, and it'll generate a 150-word narrative. Okay, so as far as generating a document, it's pretty efficient. Can help with compliance. It makes sure the documents, there's certainly AI tools in Australia that will vet our statements of advice to make sure they match compliance requirements. Okay, so any compliance people here? So AI could put compliance people out of a job. Okay, and note taking. I think the biggest, anyone using this for note taking at the moment, using FileNote.ai or a number of different ones, brilliant. Okay, record the meeting, push a button, record the meeting, and a minute after you finish, you've got a 4 or 5 page detailed summary of the discussion with what was discussed, any future actions. It's brilliant. Okay, it saves hours and increased efficiency. Now, the case against it is a lack of human judgment and emotional intelligence. It can't be emotional. Okay, and we know our dealings with the clients are all emotional. There's limitations. It's easy to misinterpret things. We can be over-reliant on outputs. Okay, we could be over-reliant, a bit like a Google search where you get one answer, and if that's correct, you get one answer from say one of the OpenAI or on the AI architectures. Without understanding a context around it, you can get a fundamentally wrong answer. Strategies are not very good, not very good strategic modelling, and while all the young people say they will at some point, not yet. And the lack of adaptability to soft goals. They don't understand soft goals because there's no emotion in it. Okay, so AI has got a place. We can use it to our advantage, but don't expect it's going to replace what we do in the short term. So let's pull it together. A few minutes over. Behavioural elements of financial planning keep us in a job. Right? Clients need us to make them do things, despite what they think. We should consider strategies to help clients manage some of the risk, particularly loss aversion. Moving away from product-focused advice to goals-based advice is a big step, but you do it progressively. It reduces the risk that regulators here will start to overreach because you're on the front foot talking about justifying what you're doing. There's opportunities and risks around auto enrollment for you guys. Opportunity, bigger pool of money. Risks, regulators get involved. Okay, so I hope it happens and it's great. And I as a tool's got a long way to go before replacing us as we need to. That's my session. Quick little plug for iFactFind, the software that we've got. If you wanted to look at ifactfind.io, not .ie, we've got a session on Thursday afternoon in Dublin if you want to come and have a look at a demonstration of it, or see me after this session. Otherwise, thanks very much for paying attention. Thanks, Damon. Thank you.
And look, I think I know we're just about time, but since he's travelled over from Melbourne, we will give go 5 minutes into the break, maybe just to no problem at all. It was fascinating. 5 minutes into the break, if that is it. So there's questions coming through here in Slido. There's a roving mic as well, so hands up. Put your hands up if anyone has questions in the room. But I suppose just there's a lot of questions in here just about the retirement, or sorry, the ban on commissions in Australia, and does that mean that consumers below a certain level are being left behind in terms of advice?
Yes, it does. I mean, in Australia we have a series of a group of super funds in Australia called the industry super funds. The funds originally originated from union-based enterprises, so the unions got together and started. It was a Labor Party initiative for compulsory super. Union-based funds. So if you're a plumber and gas fitter, there was a plumber and gas fitters fund, and they've become bigger and bigger and bigger and merged and merged and merged. And now they manage about $1.2 trillion of money. So the biggest super fund in Australia, called Australian Super, is an industry super fund, has $2 billion of inflows per month. Okay, into that fund, $2 billion of employer contributions going in. Now, it should be their responsibility. They have millions of members, and we've been working with them lately. They offer financial advice. There are 110 financial advisors to service 10 million members in their funds. So it's by definition incredibly superficial. So don't really meet the needs in that regards.
Mm-hmm.
So,
and just another clarification here is fees for financial planning, are they tax deductible in Australia?
Very topical discussion. There's supposed to be a release at the moment. The initial fees are not tax deductible. Okay. And any advice related to superannuation funds is not tax deductible because the fund would get a tax deduction, not the individual. Okay, but the new release literally this week from FPSB is around. There's ways that you can make some of the fees tax deductible, but typically not.
Okay,
yeah.
And I suppose just going back to what you highlighted earlier in the presentation, just the behavioural biases that you highlighted. I suppose what is is there one that you think that as advisors we consistently underestimate in terms of the impact on client outcomes?
Look, I think the Dunning-Kruger effect is kind of a form of overconfidence bias, right? Where people don't know what they don't know, and because they don't know it, they think they know a lot more than they know. Okay, so they don't know A, but they think they know A, so therefore they become experts in A even though they're wrong. So it's a form of overconfidence bias that clients have. And sometimes I always take the view that you've got to not put the client back in their place. You've got to make sure that they're aware that you know more than them. So find some angle that they don't know about and start discussing that. Some element of what they're talking about. Okay, but they go, oh, didn't know that. And if they don't know that, then that drops their overconfidence down and become much more listening much more to what to do.
Okay, I'm just going to throw it open to the floor here. Does anyone have any questions in the room? Okay, there's plenty coming through here on Slido anyway. So I suppose just you might take these two together. So the opt-out rate for, it's not auto enrollment, it's compulsory enrollment in Oz. Is there an opt-out option, and what's the rate?
Nope.
And can you explain ETT again?
Yep.
Briefly.
So there's no opt-out. So superannuation is compulsory superannuation. You can choose more, but you can't choose less. Okay. You can't access the money until you are 60. So access the E part, the exempt part, means I can access my superannuation. Different rules. If I'm 60 and retired, I can access my super unconditionally. If I'm over 60 and have changed jobs, I can access my superannuation unconditionally, or if I'm over 65. I can access my super unconditionally. Age pension is 67. There's a mismatch between the point of unconditional access to super and the age pension. And the second question was around the ETT. So,
Yep.
so yeah, in an academic world of pension analysis, they look at tax on the way in, tax while it's in, and tax on the way out. The three components. So in Ireland, it's exempt on the way. There's no tax as it goes into super and pension. There's no tax while it's in the pension, but it's taxed when it comes out. And capital T means fully taxed when it comes out, as it was normal income. The little t in mine, the small t, means it's concessionally taxed. It's taxed, but it's taxed at a capped 15% rate, not at the person's tax rate. So taxed 15% while it's going into the fund, or you can make a non-taxable contribution into the fund. Tax while it's in the fund at 15% and zero on the way out, exempt on the way out. So does that make sense? So when I use a small t rather than a capital T, it's concessionally taxed.
And just a final few, the rise of AI tools in financial planning, how can we ensure that technology enhances rather than replaces that human connection, which is so essential for in behavioural guidance?
Well, partly AI is very good at making product recommendations, right? Technically, because they would go, we'll ask you a risk profile question, and as long as they're linked to a product, they would give you the risk profile based outcome for that product, right? That's how most pension funds would do it themselves. Here's answer 5 questions. I'm involved with the group. Answer 5 questions. You're a balanced investor. We have a balanced fund. There's a balanced fund. Have it. Okay. So when you focus on product exclusively, you're at risk from AI taking over that role. Okay. That's why goals-based advice becomes so important. I'm focusing on other elements than just the investment decision. I often say the investment component of financial advice for me would be less than 15%. Right. The making around investment less than, it's almost automatic. Okay, so can he good?
Yeah, if I may, Paul, just congratulations, very good presentation, really insightful. Just to develop the commission model in Australia a bit more.
Yep.
Obviously, you have to get approval every year to what we would consider to be the trail to continue to giving the advice.
Yep.
And the client has to physically confirm that each year.
Twice. They've got to confirm it at the same time. If I'm taking that fee from a product, so I'm drawing an explicit fee from, say, a superannuation fund, because that's where the money is. Yeah. I have to send the form of fund signed by the client to say, yes, they're willing for 12 more months to pay that fee.
But it's paid by the fund once the client confirms.
But either way, if I invoice them every 12 months or invoice them monthly or arrange a direct debit arrangement, it's the same. I've still got to get them to agree to that fee every single year.
Okay.
And if I take a payment without that, if I miss a month, they don't get back to me, then I have strict legal liability.
Okay.
A criminal legal liability.
And in a scenario where they don't approve, how easy is it to detach them as clients? And I mean, what's your responsibility from a compliance point of view to continue to provide advice in a scenario where you're not getting paid?
If they choose not to continue with advice, the difference between they're on holidays and missed a letter, okay? In that situation where they haven't explicitly said, I don't want to keep you as the advisor, then you're still liable for the advice, okay? And even if they stop being a client, you're still liable for the advice you have given them up to that point. Doesn't mean suddenly all bets are off. Don't care what happens tomorrow. If the advice you've given turns out to be wrong in 5 years, you're still on the hook. So, but that is a strict date, and and ironically, the government who brought this rule in didn't produce a form. So every different product provider has had their own different legal teams to produce their own forms. So there's no uniform form. So I could have a client with 3 products. I've got to get 4 different forms signed by the client every time. It's
complex. We're almost out of time. I am going to ask you just to indulge me. I think that there's we spoke yesterday when we were chatting. You were telling me about the additional service that you have for clients in terms of intergenerational service. You might just share that with the group. I think it's a super service that might become more popular.
Look, in Australia, we have a problem with children, and I'll say children with respect to age who are, say, under early 30s, still living at home. Okay, the parents can't get rid of them. They're still living at the home for how long they want them to. And the parents just can't tell the kids to get out of the house. So they come to me. So we bring the kids into the office and we sit them down and I point the finger and I say, you're holding your parents back. You're irresponsible. Grow up. You've got to get out of the house. But we also give them the tools on how to get out of the house, how to save, how to use multiple bank accounts, how to get this money saved, how to allocate your income so it's coming in. And so they finish up being able to start saving and getting money ahead, even for perhaps to buy a property. But parents love it because we take the responsibility for getting them out of the house, you know.
So look, with that, I know there's just one more question here.
Yeah.
Has there been any?
Fine.
Has there been any studies done on what the management costs are now for investment business versus what they were under the commission? My understanding is that they're quite high.
They're quite low now. So you could buy, there's a trend in Australia to use exchange traded funds. I'm not sure if you guys are using them now, but that's a big deal. There's the kind of active managers are kind of really trying to get into ETFs. But ETFs, a global equity ETF at 4 basis points, Aussie equity ETF at 7 basis points, diversified balance ETF at 12 basis points. It's pretty low. So the physical cost of investing is very low. And you buy one brokerage of, say, $25 to buy the asset. Platforms, I'm not sure whether you guys use platforms, but platforms like a Macquarie or a BT platform have really come down. They used to be at 1% per annum for the platform plus the underlying. So it used to be 1% for the platform, 1% for the managed fund, and then advice on top. And now it's 0.1% for the platform, 0.1% for the products, and maybe 0.5 or 0.6 for advice. So the entire cost of investing that process is materially under 1%. Can be more, but often materially under 1%. So which compares now with the industry funds who are charging around about 1% just for the superannuation fund. So it's really come down a lot. So, and that's advisor demand by saying if we're not advisor demand if we're not part of a distribution team anymore, because we're not owned by a bank, we're all independently owned, and therefore I can become much more demanding.